Is the US economy healthy, or do we have room for concern? The latest numbers from the Federal Reserve just came out. Let's break down what they all mean. Americans added nearly $100 billion worth of debt last quarter. Higher debt is not always bad, as it can mean it's a sign of economic growth, but only if those households can manage it. It can also mean that Americans are more vulnerable to things like job losses or rate hikes. The good news is, mortgages remain the biggest chunk of this consumer debt number. In adding to that good news, mortgages aren't seeing a wave of foreclosures, and mortgage delinquencies remain stable for now. And this suggests that many homeowners either have steady income or they have solid equity in their house to keep up with their mortgage payments. However, there are some areas of concern with this rising consumer debt number, and one of the areas of concern is the rise in credit card debt. Credit card balances rose by about $45 billion last quarter, and with that, we also saw a rise in late payments. This data suggests that consumers may be struggling with day-to-day expenses. Auto loans rose, which suggests that consumers are paying more for vehicles, and student loans rose by about $9 billion. However, the reporting on student loans is paused for the time being, so we'll find out next quarter if people are falling behind on student loans. Having said all this, the amount of consumer debt that was marked late last quarter is only 3.6%, which is historically low. And while that is a positive sign, the rise in credit card balances and the rise in credit card late payments is something to be concerned about. So all this data suggests that the US economy is both healthy and stable for now, but things can change very quickly, so follow me to stay in the loop.